if you don't want to insure yourself, let's think about that contingency plan and tell me what if and you'd be willing to do in the event of you passing away. Would you sell the property and would you downsize or whatever the situation may be?
And
so
I'll just add in, Josh,
Yeah.
just on the just so people understand the income protection side of things, your income's your most valuable asset. So if you're like a young family, home loan, and you've got either husband or wife is the main income earner of the house, let's say they're on a salary of $150,000 a year. Something happens to that person and that salary's not coming in. If you think of it, say it's a 40-year-old, right? And they're going to earn 150 grand a year for the next 20 years. If that income stops, the value of that income stream is approximately $2 million.
Welcome back to the Winners Playbook. Josh here with Billy. Insurance is not exciting, but it is the safety net that keeps your plan alive. Today, we'll keep it simple and show you what cover to consider, how much, and how to avoid paying for stuff you do not need. And before we get into that, Billy, what's news on your end, mate?
Well, it's all about the tooth fairy in our house at the moment. So my oldest son's been, tooth have been dropping out for the last year or so.
Yeah.
And he's very keen on the payouts that he gets for them.
Yeah.
And he's recently, he's started claiming, other kids at school get hundreds of dollars for the teeth. And I'm like, mate, I don't think that's true, and it's not going to happen.
Oh, dear.
Anyway, so one came out the other day, and he was over the sink. So when it got washed down the drain, so he was panicking that he wouldn't get the cash. So he said, okay, write a note to the tooth fairy explaining what's happened.
That's fair. That's fair.
And so he said, okay, I'm going to write the note, but I don't want you to see it. Like, okay. So he writes his note. He's checking to make sure we're not looking. Yeah. Obviously, as soon as he fell asleep, we've gone into the note.
Yeah.
Here it is. Dear tooth fairy, I lost my tooth down the drain, and a lot of kids at my school have $938 or even $3,000. I wish I did, and remember, I lost my tooth.
He's pulling the real good the heartstrings there of the tooth fairy, I reckon. He's done well. He's absolutely done well. So geez, $100 from a tooth. Inflation's hit that pretty hard from when I used to get a few gold coins for a tooth.
Yeah, well, it's still gold coins. And so the next morning he was still asleep. So I went in and I saw him wake up, and he's just he's popped up half asleep, rushed over to where the spot is near his bed.
Yeah.
And he's like, it's just $2.
How long do they keep that one going for? How long does the tooth fairy generally stay? I'm trying to think about that one. I was pretty attuned, and I think I caught someone coming in at one point for that one. I think it was my nana, actually. I was staying over at my nana's house, and I deliberately tried to stay up and peeked my eyes open, pretending I was asleep, and seen them put the coins in the glass of water. So I figured it out at that point. I don't know.
I reckon he's going to figure it out this year, because he's going to go in. He's starting about to start grade 2, and he's going to talk to the kids about it. And I'm sure someone will break it to him, I would say.
Yeah, you can't protect against that though, can you? Because you're going to have all the kids, and then you're going to have just that little terror that disrupts it for everyone and corrupts it for everyone and tells them everything's not real. And there's always got to be one of those in the bunch.
Well, so you have to because if you fight it, then they're going to find out, and then they're going to say, you've just been lying to me all year. So I think if they press you, you sort of have to go, all right, I'm going to have to tell you something here, mate. I'm going to have to break something to you here.
Yeah.
Because otherwise, they can get trust issues.
Seriously. Yeah, but wow, $100 for a tooth. That's, I don't know if I'll be getting Leon into the habit of that one. That's brutal.
That's right. But you should be into investing though, because he's always trying to figure out how to get money without actually doing the work. So
yeah, no
teach
kidding.
him about investing and
yeah. No, definitely.
That way.
Definitely. Yeah. It might be a micro investing app. You can put his $2 in and start a bit of micro investing.
Yes. Yeah. Well, he likes hard currency. So maybe some gold coins or something.
Yeah. No, why not? You could get a little bit of gold. You could buy some of that from the mint. Well, I don't have any tooth fairy issues at my place, Billy. We take off to Perth 2 days from now on Friday. So I'm looking forward to that. Spend some good time over there, which will be good with the family and the in-laws. Leon's just causing a bit of chaos around the house, climbing on everything now. And he's very much of that stage, just kind of stomping around and doing whatever he wants and telling him no probably every 5 minutes for whatever he's doing. But he actually came out to the gym with me this morning. So we got a little home gym set up, and today's one of the days I work from home. So my wife was sleeping and I was working out mid-workout, and she sends me a message saying, Leon's up. So that's usually my cue to go in there and pull him away for a little bit while she tries to sleep. So I was like, damn, well, I normally would have finished my workout by then and then I'll go on a walk with him and do some things. But I was mid-workout. I'm like, I can't stop the workout. Like, I'm not going to give that up. So I was like, look, I'll just put some clothes on him and bring him out to the gym. And to his credit, he just sort of watched me. He was trying to sort of swing around on things, and he was doing a few pull-ups actually, assisted pull-ups with me.
Have you got him on the push-ups or anything yet? Or
yeah, he was doing some assisted pull-ups.
Dips.
Yeah, he's doing a few of those, and I think he's watching the movements of what I'm doing. So like when I do little squats and things, he starts doing some little squats. So that was fun. So he didn't disrupt my workout, which was good. And then the update on the chickens is, of my 5 chickens, I'm pretty sure 2 of my newer chickens are now laying, which is good. So the first eggs came out because you can usually tell the eggs look a bit funny the first egg that they get out, and so hopefully we're gonna get a bit of production going on the egg front now, because we still, even though we've had the chickens, we've had to keep buying eggs from the store because the chickens aren't producing enough. We only had 2 chickens and they weren't laying every day. So hopefully with this 5, I won't have to go to the stores or buy any more eggs. That's the whole purpose. But I'm massively
just trying to satisfy the demand in your household, right? It should be pretty high, I imagine.
Seriously. So, my chicken investment is so in the red, it's not even funny. So my wife tells me they're a pet, so I got to stop looking at it like that. I guess she reckons they're more of a pet, but I don't know. I don't agree with that. So, let's get into it then, Billy. So we're talking insurances. We've touched on this topic a few times. So we're going to be going through some other nuances to insurances, but we'll gloss over just quickly, what are the main insurances that us as advisors work with, because we don't work with health insurance, like private health insurance and things. They're not stuff that advisors get into. We can help our clients, reach out to certain providers and things that we know of, but it's not something an advisor specifically works with a client on, nor are we doing car insurance, home contents and things like that, or any sort of general insurance. But what are the main covers to start with, Billy, that we do work with our clients on, and just high level, what do each of those do?
Yeah, so those ones you went through there are called like general insurance.
Yep.
Financial advisors deal with what we call personal insurances, which is essentially, it's like protecting your assets and protecting your income. So there's 4 main types. There's life insurance, which is very straightforward. You die, there's a lump sum payout. TPD, or total and permanent disability. So if something really a very serious illness or injury which prevents you from working ever again, you get a lump sum payout. Income protection, again, that's for illness or injury, but it can be temporary. So it's like monthly, replaces your salary each month until you can get back to work. And then the 4th one, which a lot of people don't really know about, is called trauma or critical illness. And that covers like cancer, heart attack, stroke, and a few other things. It's like a lump sum payout if one of those events happens to you.
Yeah. And we'll talk into the ins and outs of those. But trauma is one that most people don't know about. Do you want to just touch on like why most people generally don't hold a trauma policy?
Yeah, so the life, TPD, income protection, a lot of super funds will give you default cover, or like a lot of employers will give you some cover as part of the deal when you work for them.
Yeah.
So most people know about those. Trauma cannot be done through super, and it's rarely sort of offered to you in any sort of default sense. You have to go out and actively buy it. That's why most people don't know about it. So you got to pay for it out of pocket, not through a super fund. But it's where it sort of differs is it's these list of medical events like cancer, a heart attack, etc. It's not tied to your ability to work. It's just like if one of these things happens, you claim on your policy, a tax-free lump sum is paid out. Most people would have somewhere between $100,000 and $300,000 of cover. So it can be very valuable because one of these things might happen to you and you might technically be able to go back and work full time, but maybe you don't want to because you've been through a traumatic event. So you got this extra cash, which you could use for pay for medical treatments or take some time off work to recover and that sort of thing.
Yeah, no, I think it's always best, and we'll give some real life examples on today's podcast, because that's where I think, when people say, look, do I need it? And I go, well, let me give you some examples and real life scenarios I can think of. Like the trauma one, the example I always like to use with clients is from some things I've observed and seen with not necessarily clients, but just people in general that I know, with a guy that had a heart attack at work, and then he had another heart attack, not in our business, of course, and then he had another heart attack on the way to the hospital. Fortunately survived, was back into work 2 weeks later, like back to work 2 weeks later after having two big heart attacks.
Jesus.
And so in that situation, I say, well, life insurance, good. You can't claim it because you're still actually here and you're not terminally ill or anything of sorts. Total disability, where you're obviously not totally disabled because you're back to work. Income protection, you're generally going to have a waiting period of at least 30, 60 or 90 days. So you're back to work. There's no income protection payout there. But in that sort of a situation is where you'd be looking down the barrel of a trauma payout. Even if you, like you said, Billy, you can actually go back to work. So I've had some clients claim for various things. Cancer's another one. I've seen some people get various cancers over the years where, again, they've actually been able to go back to work, had some pretty late stage breast cancer, unfortunately got through it all and they're all good. But had some trauma insurance that paid out, took the financial stress off, actually helped set them up financially as well for some of these clients. I had a couple of clients that, one client in particular had a very large policy that wasn't set up through me. They actually were set up from another advisor and they came over and started working with me, but they were already post having had it paid out. But it was a very large policy of over $500,000 and literally changed their life. Fortunately, she's all good, happy, healthy, no issues whatsoever. But yeah, it wasn't costing a great deal of money, that trauma insurance, but very much changed their life for the better. And also you got to think in that type of situation and event, if you have financial stress and pressure on you and you're going through a medical episode or whatever it may be, you can only think having that financial stress and pressure on you at the same time is, I would personally hold the belief that that would have an effect on your ability to possibly recover from whatever you're going through. Whereas if you've at least got the financial pressures absolutely taken off you, you don't have to worry too much about work because you've had a payout. I think there's very much something to be said in that mindset and that that sort of belief. So worthy of noting. We're going to talk through some real life scenarios. I think it's always good to do because I do come across clients, and I'm sure you do as well, Billy, who are like, I don't know anyone that's ever claimed. I've never seen anyone claim, why do I need it? So that's a bit of what we're going to be talking about, of course, today. But if we start with how do we figure out what someone actually needs, what do you start with there, Billy, and how do you start piecing that together?
Yeah, you start with a calculator. So we've got a lot of needs analysis. So that's just figuring out the numbers. So what are you putting into that calculator? How much you earn, how much debt you have, how much you have in savings or investments, how much you have in super. You punch in all those sorts of numbers and then it'll spit out, okay, for life insurance, you need X amount of cover. For TPD, you need X amount. So it's just going to spit out the numbers of the ideal cover, which essentially means if something happens to you, what amount of payout do you require where you'll have no impact on your financial plan and your financial situation. That's the starting point. But then, of course, some of this insurance is very expensive. So you do the needs analysis first, then you do the quotes, and then you look at the cost and you weigh up the affordability. So like in an ideal world, I'll have all this insurance, but when I see the cost, I might go, well, that's not really affordable, or that's a lot more than I can really pay. So then you'll do some trade-off discussions and select the amount of cover where you're comfortable, but it's not costing you a fortune.
Yeah. Yeah, and it very much varies for absolutely everyone. Stage of life, priorities, costs, family circumstances. There's so many variables there and in between, because sometimes I do have some clients that have unique situations where they could actually rely upon family members and therefore there maybe isn't that much of a need to hold certain covers. And the way I always like to approach it with clients is say, look, I'm going to show you what I think is fair and relevant to your situation, but you might say, hey, because of the costs, I want more or less. So there's no real right or wrong way, I think, to approach it. And every advisor's probably got their own way of approaching it. But, some of those non-negotiables, non-negotiables are generally, like clearing debt. If you've got young kids, there's a bit more of a need there. Ensuring your income is usually a pretty important one, because I always say, like, your most vital asset when you're in the accumulation phase is your ability to work and generate income. If that's compromised, you're cooked. All of everything that we've just put in place falls apart. can't keep the house, and then you have to start selling off assets. And ideally, in my view, I wouldn't want that to ever happen. If something ever happened to me, I don't want my family to have to sell everything to be able to survive. But look, it's a conversation, and that trade-off piece that you just said there, Billy, is really important, because it's like, hey, if you don't want to insure yourself for these events, let's think about that contingency plan and tell me what if and you'd be willing to do in the event of you passing away. Would you sell the property and would you downsize, or whatever the situation may be?
And
So
just that in, Josh,
Yeah.
just on the, just so people understand the income protection side of things, your income's your most valuable asset. So if you're like a young family, home loan, and you've got either husband or wife is the main income earner of the house, let's say they're on a salary of $150,000 a year.
Yeah.
Something happens to that person and that salary is not coming in.
Yeah.
If you think of it, say it's a 40-year-old, right? And they're going to earn 150 grand a year for the next 20 years. If that income stops, the value of that income stream is approximately $2 million.
Yep. Yeah.
And that's often what will come out of these calculators. You need life insurance of $2 million. That's the equivalent of earning 150 grand for 20 years.
Yep.
So the income protection is often the most critical part, especially earlier in life, before you've, accumulated assets and super and everything else.
Yeah, I think for a lot of clients who we work with in the accumulation phase, like that's where I personally feel that you're in that heightened risk mode where you're generally probably going to have some debt or a mortgage. You might have a lot of debt if you're going really hard on building wealth. Maybe got some kids in there as well that are quite young. Maybe, spouse or, one person of the couple maybe is not fully back into work and taking part-time and things. And there's a lot happening. Like that's where I see that's probably the highest risk period in my view, when you've got the young kids and the family and mortgages and all of these bits and pieces. But I think once the kids get a bit older, to the point of maybe being able to be a bit more independent, and when they can work, which is probably really getting well over 16 years of age, or even call it 18, then that's where I say, look, maybe that's when we start really dropping off certain covers at that point. But naturally, we try to reduce cover and cost wherever we can and wherever it's appropriate. But I think when you're in that mode of got a lot of debt, got the young family, yeah, look, you don't have to hold it, but I hold it all, and I try to encourage people to hold it where it's not overly and outrageously expensive. But then look, I've had some clients that I see some people pay some massive premiums, and that's because they really want to insure themselves for certain events. And I don't know what the biggest premium you've ever seen, Billy. I think I've seen one that was 100 grand.
What do you say, 100 grand? Yeah. Usually the giant premiums are where a business is paying for it, because sometimes business owners will take out massive policies to ensure key people in the business. Usually if you're just protecting for the family, you're not going to spend 100 grand.
No, you're usually not. And those are usually policies that have been in place for a long time, and that person's probably in their 70s. So because a lot of the insurances are a stepped cover where they go up with age, the older you get, the more expensive the insurance gets. So that's,
Some
really
people get attached to their policies too. If they get into their 60s, they should look back and look at the fortune they've spent on this insurance, and they're like, I'm not prepared to cancel it because I've already paid. What's that called? Sunk cost fallacy.
It's kind of like an example of that, but with insurance. And I've seen that many times. I've got some clients I work with that operate a pretty decent sized business, and there's this old policy on their father, which is costing a lot of money, and it's not even a huge amount of insurance, mind you, but they're kind of weighing up that sort of cost benefit analysis of what life expectancy might look like here, and they're like, well, we've paid it this long, it's probably worth continuing to tick on, and there's a good likelihood it will probably pay out at some point. But it's
pretty grim. It's like you always see if a car should have won, I beat the insurance company.
Yeah,
I don't know if you should look at it that way, but I think some people actually do. So.
Yeah, I think, if you probably paid something for 30 or 40 years, and that's a point I was going to actually make a bit later around some of the myths. Like a lot of people think that, that the insurance sort of owes them something, or is there some sort of residual value to insurances? They generally don't work like that at all. It's like you only claim if something goes wrong. Some of the old policies were a little bit different, where there couldn't be a component to it like that. But most insurance policies in Australia are just simply an insurance policy. If you don't claim, you absolutely get nothing. So, moving on from that, if we start getting into the weeds a little bit more around specifics and talking, maybe if we start with inside and outside super, and we talked about trauma insurance can only be owned outside of super. So that's pretty simple. No clients can pay that from their superannuation. But if we look at, say, life insurance, total disability and income protection, maybe we start with life insurance and we'll work our way through them. the inside versus outside super and the differences that some people wouldn't be aware of, Billy?
Yeah, so like as you said, trauma is the only one you cannot put inside a super fund. The other policies you can, but there are some differences.
Yeah.
Life and TPD, for the most part, we would fund that through super. And one of the reasons is you get a tax. Essentially, it's tax deductible to the super fund, so you get a 15% rebate on the costs.
Yeah.
But on the flip side of that, if you have a claim on those policies, there can be, and it's owned through super, there can be tax on the payout. So it's just weighing that up. Income protection, we will often recommend not putting that in a super fund because the premiums are fully tax deductible, or usually fully tax deductible to you personally.
Mhm.
So if you're on a high income and you pay for those IP premiums yourself, you're getting almost half of it back at tax time.
Mhm.
That's one reason is tax. And then the other reason is if you ever had to claim on that income protection, generally speaking, it's a bit more straightforward if it's not inside a super fund.
Yeah.
Because as soon as a policy is inside a super fund, you need to satisfy the superannuation legislation, like you're accessing super if you claim on that policy. So it can be trickier compared to if you just own it personally outside of super.
Yeah.
And
And
some other things too, like with TPD and IP, there are some policies and some features where you can't hold that inside a super fund. So most of the time we'll have some sort of split. Some covers are in super, some covers are outside.
yeah, and maybe going back to the taxes one on life insurance, because that does get a bit complex for people because you're looking at the SIS or the superannuation regulations, basically, because it does come down to who you can actually nominate to receive your money through super, which we've spoken about plenty of times before. You can nominate your spouse, you can nominate a child of any age or someone that's an interdependent relationship. So that kind of means you're financially dependent upon one another and you live together. And if you don't have anyone there, that's where you have to look at nominating your will. But that's where it's interesting because when your super gets paid out, if it goes to certain people, i.e. a spouse or a child who's under age 18 or financially dependent, they can basically get it tax-free, no questions asked. But when it goes to someone not in that category, that's where taxes can then apply. So that's where it's very interesting. If you want to have your life insurance left to someone who doesn't fit that category, you might actually want to consider owning a life insurance policy, which I don't do too often. And it's very, very rare I would do something like this, but I have seen it and done it before where someone owns life insurance outside of superannuation, because then you can actually nominate anyone as the beneficiary. You could actually nominate your neighbor as your beneficiary if you so wanted to on a life insurance policy. There is no restrictions on who you name as your beneficiary outside of super on a life insurance policy, but inside super, you're stuck and you have to fit the SIS rules and the beneficiary nominations, or who you can nominate basically from the SIS perspective. And that goes into the income protection that you're saying before, Billy, is that claim is a lot easier. And I don't think a lot of people would know that because they generally might just think, look, can I just pay it through super because I don't want to impact my cash flow. And sometimes that's actually what we will want to do as well. Like we don't want to impact certain clients' cash flow. But if you look from what's most optimal, it is a harder definition to claim on an income protection policy inside super. I get the exact wording, but you have to satisfy the SIS into temporary capacity definition, which is a lot more difficult and strenuous to claim upon, as opposed to if it's an outside super policy, it's got nothing to do with meeting that SIS definition inside superannuation. So if we can, outside super is generally going to be always best. You can claim it as a tax deduction. If you're a high income earner and your insurance premium costs you $3,000 a year for income protection, you're going to claim back half of that. So realistically, the real cost is probably $1,500. And when I break that down for clients, like, I have clients earning some big amounts of money. Let's just take a figure and say $300,000. Like if that policy costs someone $3,000 a year, it might even be cheaper or more expensive based upon their age. But let's just say it's $3,000 a year. They're able to insure their wage of $300K for the cost of, say, $1,500 in that year. It's like when you weigh that up, when you break it down, it's like, geez, that is not much of a premium to pay for the security that you're ultimately getting. And you're probably already insuring your car and everything else in your life. So if we're sort of compromising on you as a as a person, I don't know, I think we've got bigger issues to maybe address if that's the thought process. But I think those are really important ones. But what about TPD, Billy? Do you want to touch a little bit on the any versus own occupation? Because that is something that not many people ever really know, and you generally probably won't know unless you work with an advisor and they think it is relevant for your situation. Do you want to lightly touch on that any versus own occ definition?
Yeah, so a big deal in TPD is how do you define disability, permanently disabled, and how do you define this person can never work again?
Yep.
Because someone might have a very serious injury or illness, and the doctors might say, yeah, they're unlikely to be able to work again. A couple of years later, they might start to recover and they might go get a job.
Yep.
And the insurance company is obviously not in the business of paying out hundreds of thousands of dollars unless they're confident that that person is not going to go back to work. So every policy often have different wording around what is permanently disabled. And when you buy one of these policies, you've got a couple of options. The most common one is what's called any occupation, and that's where the definition of disability essentially says this person is unlikely to ever be able to work in a job suited to their skills, education, and experience.
That's pretty broad.
It's still pretty broad because if you think about it, if you think of like a really basic work from home, admin job or IT support or something where, you're just answering the phone, you're not doing anything complex, you could have a pretty serious disability, and maybe the insurance company could argue that you could do a really basic sort of job.
Yep.
So that's the any occupation, unlikely to be able to work in any job suited to your skills, education, experience. There's another definition called own occupation cover, and that's more specific to your job, i.e. the job you had just before the incident occurred. That policy is obviously more expensive, but you're more likely to get a successful claim on that. And the sort of thing where we would recommend buying your own occupation policy, I would say it's jobs where there's a component of like you need to be able to physically, like it's not just sitting at a computer. A classic example is a doctor, like a doctor, surgeon, a nurse, something where you have to be able to get around, use your hands. That's the sort of thing where you'd probably want the own occupation definition. Because even if you can't physically get around, obviously there's an argument that you could do some sort of desk job or something.
Yeah, and it's obviously a little bit more pricey having the own occupation definition because it is a better definition, but a lot of times the way we can structure it is you kind of what you call super link it. So you pay some component through your super fund, and then the own occupation component, you have that structured outside super. So you kind of get the best of both worlds. You're trying to save a bit on the cash flow impact, but then still retain that superior definition, because I see it a lot with, probably more higher paid execs or people in certain positions is where I would generally always look at doing it, because the last thing you really want there is you suffer what could be a total permanent disability, and then the insurer turns around and goes, well, okay, let's just say you're a CEO right now, but you've had all of this experience over your life. Like, what else could you possibly work in with that? Which is what any occupation definition kind of is, because looking at your work experience, your qualifications, and so on and so forth. So if it was if the insurer argued that you could be reasonably expected to do another role which is not that of a CEO, like under any occupation definition, there's a chance you might not get paid out there. Whereas if it's in our own occupation definition, that, like you said, Billy, they're just looking at your occupation at the time of you being disabled. So they can't turn around and say, well, no, you've done all of these other roles in the past, you'd be reasonably expected to still be able to do that. It's like, no, they're looking at your ability to be a lawyer, financial advisor, accountant, your CEO, or whatever it may be. So look, like a lot of things, it's always better than having, but again, it's that balancing amongst costs associated amongst it. And what about, Billy, maybe some examples there? Because I've dealt with a couple of TPD claims. They were never really big, but I know you have had firsthand experience in a couple of TPD claims, and that payout is actually not too easy to understand, and it's pretty complex as well with how the tax is then calculated and how that money comes out. Do you mind sort of touching on an example or two of that TPD payouts that you've seen?
Yeah, so we've had a few TPD claims come through, a couple of cases where they've already been paid out and then they came to us for advice, and a couple of cases where we're with them through the claim.
Yeah.
Not simple. I mean, certainly, like if you're legitimately not able to work, you will get paid out. but it's about how long is that, and how long and painful is that process going to be. And then once you get the payout, the tax situation is quite complex.
Yeah.
I'm talking primarily about policies owned through super.
Yeah.
This is what happens. You get successful TPD claim. The insurance company pays that big lump sum. It's added to your super balance. But now you've got to figure out how and when to actually access that, because that money is now in your super fund.
Yeah.
So when they pay out the TPD, the trustee of the super fund will then say, okay, well, given this person's had a successful claim, that means they satisfy the condition of release. So, i.e., we're going to open up your super fund for access. If you go and take the whole thing out as a lump sum, there can be a big tax bill. However, there's these nuances in the way the tax is calculated, such that if you move the money from one super fund to another, that affects the tax outcome. If you take a lump sum versus taking a pension, so like a monthly income from your super, there's tax differences there. And then, of course, there's Centrelink, because often, if you're disabled, you might be eligible for the disability support pension from Centrelink. Centrelink will means test you, they'll asset test you. And if you've got money that you've kept in super, that's excluded from the asset test. So if you take all the money out straight away, that might then preclude you from getting a Centrelink pension. Whereas if you leave all or some of it in super, you might also get the Centrelink pension plus be able to get some money from super. So there's like a load of planning that goes into that with TPD payouts.
That sounds like a minefield.
It's a minefield. And then even if you're over or under 60, that affects it, because, super's like tax-free after 60. Then there's your partners. If you have a partner, their situation comes into it. So yeah, any TBD claims, if it's, if you're talking about a decent amount of money, definitely go get some advice before you do anything.
Yeah, and would you maybe should we mention as well, like when you go to claim, obviously you can claim all of this yourself and go through the process. We obviously help clients through these, but you also got to be a little bit careful of sometimes lawyers getting involved in these, and they can charge an astronomical amount. Have you seen that before,
Yes.
Billy? Have any of your clients been actually seen a lawyer that helped them with the claim and charged them like a big percentage of it?
Yeah, I haven't seen that lawyers charge like an absolute fortune, but I've seen a number of cases where they charge somewhere between $20,000 to $50,000. But sometimes the payout's only $300,000.
Yeah.
Right. And if you've got a clear cut case, like you really are disabled, like you can't work, you don't need a lawyer.
Yeah.
You don't actually need a lawyer. And like we'll often work with a claims advocate, and he charges, 10, 15 grand maybe, but he won't charge you unless he knows you've got a case. And we'll only send you to the claims advocate if we think it's going to be a bit of a tricky case, and they're going to be able to help get it through without so much pain,
Yeah, all of the ones.
So don't just call Slater and Gordon straight away. It's like they'll take a huge cut, even if it's a simple claim.
Yeah, or like a lot of the ones I've ever had is I just help the client on the side. It's like I've had some trauma payouts, some IP payouts, and the things. And I've just said, look, we're going to initiate the claim for you. There's going to be a bit of paperwork gathering on your side, because like you said, Billy, it was a pretty clear cut scenario, so it wasn't very complex. Like I had one client that claimed for mental illness, income protection. So it's like, hey, you need to get a couple of psychologists and certain medical professionals to sign off on this stuff. And yeah, well, like I'm here just to hold your hand through it. Like they're a client we're working with, so we're not charging any extra for it, because it's like, hey, it's a pretty straightforward process. But sure, if they need more hands-on, we can get more involved, or like you said, send it to one of the professionals that actually deal in this space. But before moving on to some other bits and pieces here, Billy, what about something that, again, people will not know about unless they have an advisor, is that guaranteed renewability or not guaranteed renewable type policy, and talking to the differences there between, say, your default insurance that your average super fund just gives you. So you join Australian Super or ART or whoever it may be, and then you just opt to get the age-based insurance that it gives you, which is never tailored to your needs whatsoever, mind you. That the differences between that versus an actual policy you take out through what we would call a retail insurer, and that guaranteed renewability, it's a key sticking point. Can you touch on that one, Billy?
Yeah, so you've got like industry super, they've all got an insurance offering as part of the product. And same with like corporate super, like if you're in a staff superannuation scheme, they've usually got an insurance offer that's built in. So that's how a lot of people have their cover. It's default. So they'll just give you, oh, you've got 150 grand of cover, or you've got $3,000 a month of income protection. It's a default amount. It's usually way less than what you actually need. So there's that versus retail insurance, which means you're just applying directly to the insurance company and specifying what you want, getting quotes, specifying what you want, and then doing a direct application with the insurance company. That's what we do. That's what financial advisors help you with. First thing to note, it's the same insurance companies. Like there's only, how many are there? Like 5 insurers.
Yeah.
They all bought each other out, merged with each other. I think a Japanese company owns half the industry now. So it's all the same insurers and the same claims and underwriting that happens behind the scenes.
Yeah.
And the other myth is that industry fund cover is cheap. It's not. Like I said, it's all the same insurers. So the pricing is not, it's not special pricing usually. So that's one thing to know. But with the industry fund cover, it's called group cover. So when you get that cover, you go to the super fund website, it's got like an insurance guide that shows you like all the terms of the cover, right? The super fund can change that whenever they want. They can change how much cover you have, they can change the pricing, and they can change the contract or the terms that sit behind it whenever they want. Whereas if you apply for a policy directly with the insurer, so a retail policy, the terms of that cannot be changed to make it like against your favor. Like it can't be made worse over time. Like when you apply, that's the policy you've got. And that contract's locked in and they can't cancel it on you as long as you keep paying your premiums. So you've got way more confidence of what you're covering, what the terms are, and you've gone through underwriting properly. So when you've applied for that policy, you've answered 1,000 health questions. They know everything about your medical history. So you'll be confident that you know what the cover is, what it's covering you for, what it isn't, and it's locked in for as long as you want to keep that policy.
Yeah, I think really good summary, because it's really just you're trying to increase your likelihood of a payout in the event that you are to claim. And I remember very early on when I joined the advice industry, I was at a seminar and I forget who put it on, but they were actually going through the PDSs on certain industry funds and showing the changes of terms, like you mentioned, that happen, which you can't control whatsoever. And you're kind of just at the mercy of it year to year. And you never really probably know what's happening. And they gave some really good examples of in the PDS of like specifics and like occupations that were then excluded and so on and so forth. So, high risk occupations is one you always got to be really careful around. But we're always working with that guaranteed renewable cover, because I think the last thing you ever want is you're paying this insurance over your life and then you go to claim it and it's like, oh, well, no, you pre-existing condition, that was never going to be covered in the first place. And then you might not have even wanted the insurance if that was going to be the case. So I think with the retail insurance that all advisors work with, you've got a lot more certainty there. And if there are going to be any exclusions, at least they're known up front, because that's what happens through not the claims process, the initial application process. We go through it and it's very thorough. And then if you've got a bad back or you had whatever illness, I've actually seen a couple. I had one which is a good example, which is where advisors can really help. This guy had an issue of some rare blood clot in his brain. So he still wanted to have some insurance. I wanted to get some insurance. And so we went across literally every insurer in Australia. I said, hey, this is a situation. Will you give any cover? No. One insurer come back and said, yep, we'll give you cover. And so it's really important to then note, insurers can be really different. They all have what they call, I believe it's called their own sort of re-underwriters. Is that how we say, Billy? They're like the underwriter that underwrites the insurer.
Yeah, so there's only 2 or 3 of those, I think.
Yeah,
so they insure the insurer or something.
Yeah, they insure the insurer, exactly. But they sometimes
they have guidelines.
They set the terms,
specific health conditions and so on.
Exactly. So that's what an advisor usually does, is they go, okay, what's your situation? And then they can work it across all of these insurers. I had another client that their mum had MS. So MS was running in the family. I'm pretty sure it was MS. And so one insurer was like, we will not cover a claimable event if your client, I think my client was in their 30s, if they got MS up until, like, they were basically going to exclude it until she was 50. I think it was. And then another insurer then come back and basically said, like, we'll give cover, but it's only up until under 40 or something like that. So it was actually quite different in terms of the terms and the variance there. But yeah, that guaranteed renewable cover in a lot of situations is actually not even more expensive than some of the insurance that you can just get through your superannuation fund. So most times we will be working with that type of insurance, but there are the odd occasion where clients do have some health or pre-existing health issues and concerns, and that's where we might opt to keep some of that existing insurance open if there's no exclusions naturally on there. Because I'll get, one example there might be you took out some cover through your fund 5 or 10 years ago, and then years down the line, say 2 years ago, I don't know, you had a really bad back injury. And so on that current policy you had that you took out 10 years ago, your back would be covered and should be fine with regards to it, because it wasn't a pre-existing condition when you took out the insurance policy. But if you try to take out a new insurance policy, insurers are just going to exclude the spine. Generally, they're going to be really conservative and go full spinal exclusion right off the bat. And that just means in the event of you trying to claim on the insurance, it's not going to pay out for if it was related back to your back. So very common there might be income protection or total disability. Is that probably the most common exclusion you see, Billy? Back and mental health. It's probably another one.
Yeah, and we should note on mental health, something like 30 or 40% of TPD claims are for mental health. Right, so I've got depression, I can't go back to work ever again, that sort of thing. So you can imagine how those claims drag out. And that's part of the reason the costs of these policies are going up. A lot of people are claiming on mental health grounds.
Yeah.
And it also means it's the first thing they're going to exclude from your policy if they can. So if you go to apply for insurance and you've had any anxiety, panic attacks, and you've ever seen a doctor or a therapist about any of those sorts of things, they'll say, okay, you've got a mental health condition, so we're not covering you for mental health.
Yeah, they're generally very conservative around a lot of that stuff. But this is, again, where a good advisor can come in, because I've had multiple occasions I could talk to where the insurers come back and said, hey, exclusion on this or whatever it may be, and then we've pushed back on it, given more information, and they're like, oh, okay, no, they've actually changed it or reduced the type of exclusion, or given us certainty around when that exclusion might be able to be removed. Because I've had clients that have had, say, a back injury or broke a bone somewhere, and then the insurer says, all right, well, that's an exclusion on your right leg because you broke it last year. But it's like, okay, well, is that going to be a permanent exclusion? Well, no. How long, would you want full recovery? How long is that going to take? Oh, yeah, we want 2 or 3 years with no symptoms, and you're not seeing an ongoing medical practitioner for support or whatever it may be. And then we can take off the exclusion. I've had that happen so many times as well. So I think there's some of the particular nuances. Was there any other ones we wanted to cover off in there, Billy, that we didn't hit there?
No, I think they're the main ones. Yeah.
Yep. And common claim or just myths in general around insurance. I had 4 here, Billy. Do you have any common myths that you see? I think we actually answered a few of mine, because I had here, all policies are the same. I think we kind of just debunked that just then with the differences between policies in super funds and not. Any common myths that you see in the insurance space, and how do we debunk them?
I've heard there's just it's a scam and you can't claim. That's total BS. Every client I've seen who's had a legitimate claim has been paid the claim.
Yeah.
Especially if they've got the retail policy that had full underwriting at the start, they went through the process properly. You will get paid if you're entitled. So that's a total myth, that one. And the insurance companies are terrified of bad media too, because years ago there was a couple of cases where they were really nasty on claims and dragged it out and so on, and they were all over, what's it called, 60 Minutes and Current Affair and everything. So they're pretty good, and especially if an advisor or a claims advocate is helping you out.
Yeah.
The other one is you lose your job and you try and claim. You can't, unfortunately. It doesn't tell me what for losing your job. It's got to be injury or illness.
Very good.
The other one I have is that, but what if I get hurt and it's not at work? So this is not the same as work cover. You can be on holiday and get injured, you're covered. You can be overseas and get injured, you're covered generally.
Yeah.
So it's not about work-related injuries. It's any injury or illness that prevents you from being able to work. They're the main ones I've got.
Yeah, no, that's good. And another thing I was going to throw in there, like I get it quite often where someone says, look, I'm young and healthy. Do I need this? And so it's
the best time to get it.
Yeah, because it's usually the easiest because the insurance process. I remember when I first did my insurance many, many years ago, I answer all the questions like no, 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 no. And it's you generally get accepted straight away on the spot. But we can't hide the fact naturally as we all get older is usually when things can start to go wrong and you could find yourself in a position where something occurs and you're like, oh great, well now I'll just get insurance because there's probably a chance I might claim on this thing. Well, exclusions, insurers may not even offer you insurance from the get-go and then you might, oh, what's the purpose of even having it? So look, the earlier you can get it, the better off. But for sure, there's a trade-off between the costs, and that's why you want to make sure the cover that you do hold is relevant. Like I've got some single clients, in their late 20s, early 30s, no kids, focused on their business. They don't need, in a lot of times, a hell of a lot of life insurance, and maybe any life insurance at all. The more important ones might be the income, the total disability, the trauma insurance. And so, what fits you, what fits someone else can be very, very different. But the myth of like, I'm young and healthy, this will never happen to me. Everyone's generally known someone that's something's occurred to or passed away and there was no insurance. I can even talk of my own experience. Like when my dad passed away, there was no big insurance policy or anything left. And if there was, I'm sure my mum's life and, life probably for us in general would have been a lot different growing up, but there was literally nothing. So, unless,
I've seen several clients that they're around sort of late 50s, early 60s. So kids have moved on, but they've still got a mortgage, they still need to build up their super.
Yeah.
One of them dies, and where they have insurance, that partner, they're grieving, they're going through a tough time. Well, guess what? At least on it, they don't have to go back to work if they don't want to. They've been paid out the $1 million or whatever it is.
Yeah.
Debt's cleared, super's topped up, and they can choose what they want to do with their time. So,
yeah. And I think another point I wouldn't mind just before we get closing out here on for business owners in particular, it's always one I try to bring up with any client I've got in business where they're actually got multiple owners in the business. Do you want to touch lightly on buy-sell insurance, Billy, and how that works and why this one can be relevant for business owners? It sort of ties into everything that we've just spoken about, but then for business owners specifically, why they might look at getting some insurance policies.
Yeah, it's often referred to as key person insurance.
Yeah.
It's sort of like in a family, if one person's the main income earner, they're a key person in terms of their income supporting the household. And even the person who's not the key income earner, they might be looking after the house and the children. So they're a key person as well, really. Mm-hmm. In a business, you have key people. Let's say you have two business partners. If something happens to one of those individuals, they die or a TPD type event happens, that's going to cause massive disruption to the business and they won't be able to perform their role there anymore.
Yep.
So you'll often, as a business owner, you'll often look at insurance to cover those risks. So you take out life and TPD on the key people. And if something happens to one of those people, that payout might be used to essentially sell their shares, like exit them from the business. The insurance payout is used as the compensation for them selling their stake in the business.
Yeah.
And you'll have a contract that covers the events and how that's going to work. You can also have insurance where it injects funds into the business if one of those events happens. That area is a lot more complex.
Yeah, it is.
But yeah, that's a common thing that business owners will cover.
Yeah, and commonly gets overlooked, and it's something that does fall part of your shareholders agreement in when you're building your business and really scaling it up, and there's going to be multiple people there involved. But it's a very important one because if you don't have certain measures in place, you could be looking down the barrel of, like, let's just use an example, a business is worth 10 million, it's owned 50-50 by two business partners, and if one of the business partners passes away or is totally disabled and they're out of the business, those shares might be getting left they would be generally getting left to the estate if there's no plans in place. And then you could very much find yourself in a situation where that spouse of your business partner is now getting involved in your business because they're the beneficiary or the owner of all of the estate and they've gotten all of the wealth. So that's generally where you start having these discussions, because it's like, okay, well, we want to ensure that the surviving spouse of that person gets their money. So that's where you might look at owning a policy on each other and say, all right, we agree the business is worth $5 million. And therefore, if one of us was to pass away tomorrow, we have in the agreement that basically this insurance policy would pay out the estate or the spouse, the equivalent of the value of their equity. So spouse is happy. business owner that's still surviving is very happy because they don't have to deal with the spouse that has no idea probably about the business and could disrupt and possibly even blow apart the business. Like this stuff could literally blow apart a business if it can't get through this, because you could also have that surviving spouse going, oh, I want to sell my equity and, sell that to someone or a private player or whatever it may be. So it's really clean to have discussions around this. And in that situation, then you end up with the one owner owns all of the equity, business can continue on and everyone's happy from that perspective. But those insurance policies, like we were saying a little bit earlier, when we generally see those bigger costing insurance policies, they're generally on business owners that are holding these policies on each other, and they're large sums insured, or they're a little bit older and they've held them for quite some time. But you have the business that actually pays the insurance in that situation. You don't actually pay it personally yourself. So business, buy, sell, or key person insurance, very, very relevant. And
wills is probably a whole separate topic. But if you're listening to this and you're thinking, okay, do I need insurance? If I was in my 20s, I would take out life and TBD of $1 million and an income protection policy. It's very cheap when you're in your 20s. You can even just put it in super. So if you do it then, I can tell you, most people have some sort of medical events of some kind happen in their 30s. And you're sort of preempting, if I do end up starting a family or buying properties and borrowing money or going into business, at least you have some cover in place and it's not costing you much. Yeah. So for me, I would always buy some insurance in my 20s just to get it in place while I'm hopefully young and healthy.
Yep.
And then if you're going to start a family and buy a first home, that's when you really need to ramp this right up. So that's where I'll be going through the process properly, needs analysis, applying for policies, or seeing an advisor if I'm not confident of doing it myself. I think that's the main lesson here. Then lastly is, as you get older, kids are growing up, hopefully you're building up some wealth. Yes, cut costs, time to scale back. That's generally the journey for these sorts of insurances.
Yeah, and we really look at reviewing it yearly with our clients, basically. So at our annual reviews, we're looking at the policies. How's wealth tracking? Do we need to adjust the covers? But life events is a really big one there, because new baby, higher income has gone up significantly. You might want to adjust your income protection up because it doesn't automatically adjust up. Most policies, unless you turn it off, will have indexation. So they go up with like a CPI every single year. But if you have a big pay increase, you might want to you'll have to actually reapply at that point in time to get some additional coverage, buying new properties, more debt. Like there's a range of different circumstances there, or scenarios where it might actually warrant a big adjustment in your insurance. And that's why you have an advisor there that can make sure you're getting the best deal, and you're obviously knowing what you're protected for. And wills, beneficiaries, it all ties into this whole conversation, which is some of the other things that we have discussed on other podcasts. But Billy, I don't think there was any other key points we wanted to run through today, did we?
No, that's it. I think we've covered it. Probably last thing is, don't just crack the shits and cancel your policies when you get that renewal notice. It's very easy to reduce your insurance. It's not all or nothing. Like you don't have to just go, screw this, I don't want to pay, I'm canceling the whole thing. It's very easy just to cut the levels. We see that happen all the time, so I thought I'd throw that in there.
Such a good point to finish on, because insurers are happy for you to reduce cover any day of the week, but increasing it always requires underwriting. And I've seen before where people have cancelled and gotten rid of insurance, and then they're years later like, oh, I want to go and apply for it. I want the insurance now. I wanted to save a bit of money for a few years. Oh, but then they've had some health concerns, the back's got a problem now, and it's like, well, now you're looking down the barrel of exclusions, or maybe not even getting any insurance whatsoever. So it's one thing we always say, particularly when you're moving superannuation funds, it's why you always want to look at your insurance needs before you move out of one fund to another, because when you move your money out of one super fund to another, you're generally cancelling all of the insurance in the pre-existing fund that you have got. So you've got to be really, really careful around this stuff, because if not, it can come back and bite you in the butt. So we've obviously covered off a lot. It's been a pretty juicy podcast there, I think, talking a lot of nuances on the insurance side of things, which is generally not the most exciting and sexiest space of advice that we as advisors work within. I'll tell you, as advisors, insurance is not the most exciting area of what we do by a long margin. I don't know too many advisors that really get up every day and go, I want to do some insurance analysis with clients today. But hey, they are out there. There are some insurance.
There's a few still around.
There's a few
diehards still out there.
Yeah, but very much a conversation that advisors will always have with you. So if this resonated or you want to reach out and have a chat, obviously jump on the website. You can speak with any of the advisors at the business, or just reach out to your own advisor or have a search online. There's plenty of advisors out there that can ultimately help you. But I hope you got a lot of value out of today, and if so, give us 5 stars on Spotify and Apple because it really helps us a lot. And until next time, we'll see you then. And Billy, I'll catch you on the next podcast.
Cheers, Josh.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.